Hi everyone, my name is piterpakulski. Today I would like to show you the final version of the financial model of a pharmacy. I will go through all the inputs from the very beginning till the end. I will show you what parameters different entrepreneurs want to play with when they finish the modeling. What parameters what items you have to pay attention to when you are going to open this business. So if you find this video valuable, you may give us a like, subscribe our channel, you can share this video with your friends. Also, you can order a financial model from scratch for your business idea or for your existing business. We can help you with that. And let's go. The first rule for any financial model is that all inputs must be colored with a specific color. It is in our case it is blue, like this. So this is the input, this is the input. I hide all the formulas. So and you have to, when you start financial modeling and when you have some business idea concerning pharmacy, the first thing you have to deal with is you have to create different types of customers, because all customers are different. They have different purchasing behavior, and we will differ our customers by check. The first difference will be the check, and the second type will be how many times each customer comes to our pharmacy per month. So it is very important, the intensity, how intensive the purchasing process of this or that customer type. First of all, we just we just create different types of customers, and we can switch them on and off to see what will be the financial efficiency, simple payback period, discounted payback period, net present value, how much money we will need if we switch on or switch off this or that customer type. Because for example, we can assume that this customer, for example, can have a very optimistic average check, and we need to know how and we see the payback period, simple and discounted payback period with this customer type. And for example, we would like to switch him off to see how our business will perform if we don't have such an optimistic type of customer. So we just switch off all the cash flows, inflows and outflows concerning this customer. Then we go to the simple and discounted payback period and see what happens with our business idea without this customer. And now we just understand that we are very optimistic and we should think it over and change the concept. Also, for example, we can, without switching it off, we can say that, for example, if the average check will decrease on 50%, well, for this type of customer, what will happen with our payback period. So, and we can analyze the influence of this or that customer on financial efficiency. So we can play with the switch on, switch off buttons to see how business will perform. The same thing with direct costs. So we can adjust the direct costs. We can use some coefficients. For example, we can assume that, for example, if direct costs will grow twice, so for example, without changing manually all the data, we're just using a coefficients to create different scenarios. So usually when the financial model is done and when entrepreneur sees the cash flow statement, we see the amount of financing that he needs. He always wants to play with the data, and the process of creating new scenarios must be very easy, because the more scenarios, the more amount of scenarios you can create, the more you know about your business idea. This is very important. Then we set up how many times each customer type visits our pharmacy per month. We also have a coefficient to this value. We can adjust it. Then we can adjust how many different customers come to our pharmacy per month. So for example, we have for example our customer number 10 with an average check of $2,000. He comes to us, one customer comes 7 times a week, 7 times a month, and we have 72 customers number 10 per month. So and we start just specifying information about one customer. Then we specify how many such customers we have per month. Then what we do, then we assume that we have some seasonality in different types of customers. So we can increase the revenue from this or that type of customer. For example, in January, decrease it in summer, for example. 100% means that it is a basic revenue. And here we can play with seasonal coefficients for each type of customer, because when you start playing with these coefficients, you may find very interesting information that will affect your brain, your business concept, and you will just have to think it over. Then you set up the moment when you have the first revenue, when you open your pharmacy. So you just set up the month, year, and then we have a very important block of inputs where you specify how fast you reach the revenue that you planned. For example, when you open, you only have 10% of revenue that you've planned. On the next month of operating activity, or the second month of operating activity, you have only 20% of what you planned. And you're reaching the planned numbers, for example, very slow or very fast. And why you need this block of inputs? You need this block of inputs to see more clearly the amount of financing that you need when you start your business. For example, we move to cash flow statement and see this moment. See this interval, and here you can see the operational losses during 4 first months when we start operating activity. And for example, we can create a new scenario. For example, if we reach the revenue, the planned revenue, for example, right on the first month, let it be so, let's just imagine that. Now we go back to the cash flow statement, and we see that we don't have operational losses here. Then we can see that we need less financing because we don't have operational losses, just like this. So here we have $290,000. And for example, if we go back and undo here 100%, then we move back to our cash flow statement, how the amount of financing increased, which we need to start the business, because we have here an operational losses that we have to finance from our pocket, equity, using equity or loan financing, it doesn't really matter, but we have to compensate these losses. And when entrepreneurs create cash flow statement, they see these operational losses. They start playing with these numbers to see what is the minimum, what is the maximum of operational losses amount, because they have to have this money in pocket to finance their business. Otherwise they will go bankruptcy, because they won't have enough money to finance their business before it reaches the break-even point. So and in this case entrepreneurs create 20-30 scenarios of financial model to see will this happen, what if that happen. So they start exploring their business idea very intensively. Then we move to payroll. We describe the positions, the salary of one person on each position. Then from the moment when we start operating activity, we specify the amount of people on each position from the moment we start, and then to the future. Then we specify fixed costs, for example rent, advertising, and other fixed costs. They also may have some seasonality. Here we can specify the seasonality inside the typical year. Then we move to investment plan. Here we just see the moment when we start operating activity and to the past. From this moment we just specify the investment items that we have, and we specify the amount of investment, when we invest, here the timeline, what we invest in, and how much we invest. So this is the investment plan. Then we specify, if we have a loan, we specify when we get the loan, the amount of loan, the interest rate, the loan term, grace period for principal payments, for interest payments. Then we specify the tax rates. Then we move to cash flow statement and see what is the profit of your business idea each month. Here it is. Then we can see at cash balance at the end of the period how our business idea generates the cash flow, cumulative cash flow at this or that moment. Then we move to the revenue expenses sheet, and here we can see the simple table, just where you can see total revenues, total expenses, profit, net profit, profitability of the business. Then you can always go to simple and discounted payback period diagram to see. You're just playing with inputs. So usually entrepreneurs play with inputs and look at this diagram, simple and discounted payback period, and look at the financial efficiency itself. So they just the algorithm is the following: playing with numbers, looking at the diagram, and what is the actual numbers values of financial efficiency. So usually the algorithm looks like this. Then we have the sheet where we specify the discount rate, the step of changing the discount rate to calculate internal rate of return, and the internal rate of return goes here. And then, for example, we would like to for sensitivity analysis. Different entrepreneurs want to play with different inputs. Just add a coefficient to expenses or to revenues to see what will happen if these revenue or expenses go up or go down. So what we can do, for example, we can take this average check. For example, we have an average check, and we can multiply it on the parameter for sensitivity analysis. And now we can go back to sensitivity analysis, and we can see what will happen with financial efficiency if the average check from customer number 10 will increase or decrease. And we just press the sense button and we'll see the financial efficiency. For example, now we want to delete the parameter for sensitivity analysis from here, and we want to know what will happen with financial efficiency. For example, if salaries go up or salaries will increase or decrease. So what we can do, we can just multiply the salaries on this coefficient. So we can link different parameters of inputs to this parameter. So all the salaries now are linked to the sensitivity analysis. Then we move back to sensitivity analysis. Then we, for example, want to increase the step of changing the parameter. We can see how values changed here. Then we press sense button and we'll see what will happen. So now we can see what will happen to our business ID if the payroll will rise twice or decrease to 90% of what we have today. And usually entrepreneurs link these parameter to different values of inputs and see what will happen to the business ID if this happens, if that happens, how the amount of financing will change if the expenses rise, if the revenues will fall. So this is the general situation when entrepreneurs have their financial model done, and they usually create 100 scenarios to fill their business idea. Usually in creating these numerous amount of scenarios, entrepreneurs in the first for the first time in their life discover the real profitability of their business idea. They find out the real amount of financing that they need. So lots different discoveries really are made when entrepreneurs start playing with numbers, with values of inputs. And I decided to show you this process because it's very important for the new entrepreneur to feel his business idea. That's why I decided to make this video for you. If you find this video valuable, you may give us a like, subscribe our channel, share this video with your friends. Also, you can order financial model from scratch for your business idea or for your existing business. So see you next videos. Thank you and bye.